Hi, I'm Steve Rosenberg. I'm 22 from Ann Arbor, Michigan. It's a privilege to be here. First, I'd just like to thank you both for serving as a hero and positive role model for me and many others. Much more than your success itself, I respect your unparalleled integrity. I have three quick questions for you. The first is how a youngster like myself would develop and define their circle of competence. The second involves the role of creative accounting and the stories of tremendous growth and success over many years. GE, Tyco, and IBM immediately come to mind for me. But I was hoping you could also discuss that issue in relation to Coke. Some people have said that their decision to lay off much of the capital in the system onto the bottlers who earn low returns on capital is a form of creative accounting. On the flip side, others counter that Coke's valuation at first glance on, say, a price-to-book metric is actually less richly valued than it seems because they earn basically all the economic rents in the entire system. My final question is if you could comment on the A.W. Jones model, the long-short equity model. I understand that it doesn't make sense for capital the size of Berkshire's to take that type of a strategy. But it just seems to me that playing the short side in combination also seems incredibly compelling, even given the inherent structural and mathematical disadvantages of shorting. And I was wondering if you could talk a little bit more about why you would have lost money on your basket of 100 frauds.
Yeah, it's an interesting question, and we'll go in reverse order. Many people think of A.W. Jones, who was a fortune writer at one time, and who developed the best known hedge fund whenever it was in the early 60s or thereabouts, maybe the late 50s even. And for some of the audience, the idea originally with A.W. Jones is that they would go long and short more or less equal amounts and have a market neutral fund so that it didn't make any difference which way the market went. They didn't really stick with that over time, and I'm not even sure whether A.W. Jones said that they would, but sometimes they'd be 140% long and 80% short, so they'd have a 60% net long or whatever it might be. They were not market neutral throughout the period, but they did operate on the theory of being long stocks that seemed underpriced and short stocks that were overpriced. Even the Federal Reserve, in a report they made on the long-term capital management situation a few years ago, credited A.W. Jones with being sort of the father of this theory of hedge funds. As Mickey Newman, if he's still here, knows, I think it was in 1924 that Ben Graham set up the Benjamin Graham Fund, which was designed exactly along those lines, and which even used paired securities. In other words, he would look at General Motors and Chrysler and decide which he thought was undervalued relative to the other and go long one and short the other. So the idea, and he was paid a percentage of the profits, and it had all today's hedge funds, except it was started in 1924. And I don't know that Ben was the first on that, but I know that he was 30 years ahead of the one that the Federal Reserve credited with being the first, and that many people still talk about as being the first A.W. Jones. Ben did not find that particularly successful, and he even wrote about it some in terms of the problems he encountered with that approach. And my memory is that a quite high percentage of the paired investments worked out well. He was right. The undervalued one went up and the overvalued, or the spread between the two, narrowed. But the one time out of four or whatever it was that he was wrong, lost a lot more money than the average of the three that he was right on. And all I can say is that I've shorted stocks in my life and had one particularly harrowing experience in 1954. And I can hardly think of a situation where I was wrong if viewed from 10 years later, but I can think of some ones where I was certainly wrong from the view of 10 weeks later, which happened to be the relevant period. and during which my net worth was evaporating and my liquid assets were getting less liquid and so on. So it's all I can tell you is very difficult. And the interesting thing about it, of course, is A.W. Jones was a darling of the late 1960s, and Carol Loomis is here, and she wrote an article called "The Jones Nobody Keeps Up With," and it's a very interesting article. But nobody was writing articles about A.W. Jones in 1979. I mean, something went wrong. And there were spin-offs from his operation. Carl Jones spun off from his operation. Dick Radcliffe spun off from his operation. You can go down the list. And out of many that left, a very high percentage of them bit the dust, including suicides, cab drivers, subsequent employment, the whole thing. And these people there was a book written in the late 60s, had a lot of pictures in it. I don't remember the name of it, but it showed all these portraits of all these people that were highly successful in the hedge fund business, but they didn't bring out a second edition. So it's just tough. Logically, it should work well, but the math of you can't short a lot of something. You can buy till the cows come home if you got the money. You can buy the whole company if need be, but you can't short the whole company. A fellow named Robert Wilson, there's some interesting stories about him. He's a very smart guy, and he took a trip to Asia one time being short. I think it was Resorts International, or maybe it was Mary Carter Paint, it was still called in those days. And he lost a lot of money before he got back to this country. He's a very smart guy. He made a lot of money shorting stocks, but it just takes one to kill you. And you need more and more money as the stock goes up. You don't need more and more money when a stock goes down if you paid for it originally and didn't buy it on margin. You just sit and find out whether you were right or not. But you can't necessarily sit and find out whether you're right on being short a stock. I think I'll let Charlie comment on that before I go to your other two questions.
Well, he asked about creative accounting, and he named certain companies. I wouldn't agree that all those companies were plainly sinful, although I'm sure there are very significant sins in the group as a whole. Creative accounting is an absolute curse to a civilization. You can argue that one of the great inventions of man was double entry bookkeeping, where we could keep our economic affairs under better control. And it was a North Italian development spread by a monk. And anything that sort of undoes the monk's work by turning this great system into kind of a tool for fraud and folly, I think does enormous damage to the country. Now, I think a democracy is ordinarily set up, so it takes a big scandal to cause much reform. And there may be some favorable fallout from Enron, because that was certainly the most disgusting example of a business culture gone wrong that any of us has seen in a long time. And what was it took in eventually a lot of nice people that you wouldn't have expected to sink into the whirlpool. And I think we'll always get Enron type behavior, but it may be moderated some in the next few years.
The question of accounting and the economic profits to be gathered in the bottling system versus the production of the syrup at Coke. I've just gotten through reading the annual reports of CocaCola FEMSA and Panamco, which are two big Latin American bottlers. And I mean, they make pretty decent money, quite significant money. And there is more money in owning the trademark. It isn't the plants that make the syrup or anything else. The trademark is where a huge amount of value is. The trademark is where a huge amount of value is in See's candy. Those are big assets. And I would say that you can make good money as a bottler. A lot of bottlers have become rich over the years. If I had a choice between owning the trademark and owning a bottling business, I'd rather own the trademark. But that doesn't mean the bottling business is a bad business at all. And it's riding on the back of a trademark. I mean, that is why a bottling system is valuable is because it has the right to sell a trademark product which hundreds of millions of people every day are going to go in and ask for by name. And the right to distribute that product is worth good money. And I don't see any accounting questions in that sort of thing. In other words, if the Coca-Cola company did not own a share in any of its bottlers, and for many years it either owned 100% of a bottler or large part, or and very few of those or none of it. But if they own no interest in their bottlers, I think the economics would be very, very similar to what they are now. I mean, the bottlers would still be able to borrow a lot of money because they would have contracts with the Coca-Cola company and that were important and that would allow them to make decent money distributing the product, but they don't make the kind of money that you make if you own the trademark, just the way it works. What was the first question again?
It was how a youngster like myself would define and develop a circle of competence.
Oh yeah, that's a good question. I would say this: if you have doubts about something being in your circle of competence, it isn't. I mean, in other words, I would look down the lists of businesses, and I will bet you that you can. I mean, you can understand a Coke bottler, you can understand the Coca-Cola company, you can understand McDonald's, you can understand, you can understand in a general way General Motors. You may not be able to value it, but there are all kinds of business. You can certainly understand Walmart. That doesn't mean whether you decide whether what the price should be, but you understand Walmart. You can understand Costco, and if you get to something that your friend is buying or that everybody says a lot of money's going to be made in, you're not sure whether you understand it or not, you don't. I mean, and it's better to be well within the circle than to be trying to tiptoe along the line. And you'll find plenty of things within the circle. I mean, it's not terrible to have a small circle of competence. I'd say my circle of competence is pretty small, but it's big enough. I can find a few things. And when somebody calls me with a Larson Jewel, that is within my circle of competence. I hadn't even thought about it before, but I know it's within it. I mean, I can evaluate a business like that. And if I get called, I got called the other day on a very large finance company. I understand what they do, but I don't understand everything that's going on within it, and I don't understand whether I can continually fund it, on a basis independent from using Berkshire's credit and so on. So even though I could understand every individual transaction they did, I don't regard the whole enterprise or the operation of it necessarily as being within my circle of competence. Charlie?
Yeah, I think that if you have competence, you almost automatically have a feeling of where the edge of the competence is. Because after all, it wouldn't be much of a competence if you didn't know its boundary. And so I think you've asked a question that almost answers itself. And my guess is you do know what you're in all kinds of areas. And you do have all kinds of other areas where you know you'd be over your depth. I mean, you're not trying to play chess against Bobby Fischer or do stunts on the high trapeze if you've had no training for it. My guess is you know pretty well where the boundaries of your competence lies, and I think you also probably know pretty well where you want to stretch the boundary. And you've got to stretch the boundary by working at it, including practice.
One of the drawbacks to Berkshire, of course, is that Charlie and our circles largely overlap, so you don't get two big complete circles at all, but that's just the way it is. Probably why we get along so well, too.